The correlation secret. Discover the little-known secret that powerful institutional traders use repeatedly to profit from the fundamental connectivity of different currency pairs. Dear fellow trader, I would like to open up this report with some rather shocking observations. They may seem unrelated at first, but bear with me because I promise these observations have everything to do with you becoming a more confident and profitable Forex trader. Okay, I hope you're ready because here comes the first, shocking observation. Shocking observation number 1, as temperatures increase, sales of ice cream increase as well. Shocking observation number 2, as temperatures decrease, the volume of clothes that people wear increases. Wow, that's some seriously shocking stuff, isn't it? Okay, by now you probably realize that I'm joking. Clearly there's nothing shocking about these observations. In fact, they're about as common sense as it gets. Everyone knows that as the weather warms up, people like to eat ice cream because it's cooling and delicious to eat in the summer heat. Furthermore, we all know that as the weather turns colder, people tend to wear more clothes because it's necessary to stay warm. These relationships, i.e. increased temperatures equals increased ice cream sales and decreased temperatures equals increased clothing volume, are so common sense and fundamental, in fact, that we likely ignore them completely. But imagine if blatantly obvious relationships like these existed in the Forex market? And more importantly, imagine if these common sense and fundamental relationships could be used to give you an edge and actually increase your trading accuracy and profitability? Well, believe it or not, these relationships do exist in the Forex market. They're called correlated pairs, and in this report I'm going to show you how you can capitalize on these correlated pairs and correlation trading in general to make more money than you've ever made before trading Forex. I'm even going to give you one of my tested and proven correlation trading strategies. It's called Follow the Leader, that you can begin trading almost immediately. But before we get into the trading strategies themselves, we first need to take a closer look at correlated pairs so you can see how they work and more importantly how we use them to get an unfair advantage over just about every other trader. What do correlated currency pairs look like? The first step to profiting from correlated pairs is to learn how to recognize them. Fortunately for us, that step is actually quite easy as you can see by the example below. Even at first glance, you should be able to detect a clear relationship between these two correlated currency pairs, Euro to US dollar and US dollar to Swiss franc. Can you see how they're almost always moving in opposite directions? Can you see how when the Euro to US dollar goes up the US dollar to Swiss franc tends to go down, and vice versa? If not, look again. Note, this time I've placed lines on the chart to make the relationship even more obvious. As you can clearly see, the charts for the Euro to US dollar and US dollar to Swiss franc are almost perfect mirror images of one another. When the Euro to US dollar goes down, the US dollar to Swiss franc tends to go up. And when the Euro to US dollar goes up, the US dollar to Swiss franc tends to go down. This relationship is known as a negative correlation, because these two correlated pairs almost always move in opposite directions of one another. If the concept of negative correlation is still a bit unclear, think back on the second, shocking observation I gave you at the start of this report. If you recall, as temperatures decrease, the volume of clothing that people wear increases. So in other words, temperature and clothing volume almost always move in opposite directions. As temperatures decrease, clothing volumes increase. As temperatures increase, clothing volumes decrease. Think summer bikinis. Okay, by now you should have a pretty firm grasp of negative correlation and what it looks like, so let's move on to the second type of correlation, positive correlation. The example below is an example of two positively correlated currency pairs. Unlike the previous example, these currency pairs are moving more or less parallel to one another. Once again, to further illustrate this point, I have drawn lines on the chart to show the correlated movements of these two pairs over time. This example is similar to shocking observation 1. As temperatures increase, ice cream sales also increase. So once again, since the movement of both temperature and ice cream sales are in the same direction, this is an example of positive correlation. By now you should have a firm understanding of positive and negative correlations and how to recognize them on a chart. So next let's discuss why some currency pairs are correlated and others are not. It's all about the fundamentals. At this point you're probably wondering, why are currency pairs, like the euro to US dollar and US dollar to Swiss franc, correlated in the first place? What causes these positive and negative relationships to exist? Well, much like our temperature and ice cream and temperature and clothing examples from before, currency correlations come down to basic fundamentals. Increased temperatures are correlated to increased ice cream sales and decreased temperatures are correlated to increased clothing volume for two simple but extremely powerful fundamental factors, comfort and survival. People eat ice cream when it gets hot because it makes them comfortable, and they wear more clothing when it gets cold for the same reason, comfort, and in some cases survival. The point is, the factors that drive these correlations are deeply rooted in daily life. They won't change. Not this year, not in 10 years, not in 100 years. The fundamentals behind these correlations are universal. The same is true for correlated currency pairs. There are literally dozens of correlated currency pairs, but what follows is a partial list of some of the most significant pairs, and the fundamentals that back them, the euro to US dollar and pound sterling to US dollar, for example, are positively correlated because the base currencies, i.e. the first currencies listed, of these pairs, the euro and the GBP, represent European Union member states. So they're very, very similar both from a monetary policy and from a geographical sense. In other words, when EU makes a shift in monetary policy or when there's a major change in the European economy, both the euro and the GBP are affected in the same way, because they're both European currencies. The euro to US dollar and US dollar to Swiss franc, on the other hand, are negatively correlated because the base currency of the first pair, the euro, and the base currency of the second pair, the USD, have very different monetary policies, economics, and geographic locations. So for the same reason the previous pairs were positively correlated, these pairs are negatively correlated. Now, allow me to let you in on yet another fact. Did you know that currency pairs with CAD, NZD, and AUD as their base currencies will all tend to be positively correlated with one another? It's true, and in this case it has nothing to do with monetary policy, and it certainly has nothing to do with geography. After all, Canada and New Zealand couldn't be farther apart. In this case, the CAD, NZD, and AUD are all correlated because all three countries, Canada, New Zealand, and Australia, are heavily dependent on commodity exports, meaning their currencies all have strong ties to the commodities markets. Therefore, as commodities move, so too do these three currencies, and typically in the same directions. By the way, if by any chance you found this section confusing, please don't worry about it. I have some good news. Just like you don't need to fully grasp the workings of an internal combustion engine to drive a car, you also don't need to fully grasp the detailed fundamentals behind the different currency pair correlations to profit from them. In fact, all you really need to know is, strong fundamentals are behind correlated currency pairs. This gives you a consistent, predictable model from which to trade. In other words, just like we can count on increased temperatures remaining correlated with increased ice cream sales because it's backed by fundamentals of daily life, you can also count on the euro to US dollar and pound sterling to US dollar remaining correlated because they too are backed by universal market fundamentals. Predictable volatility equals profit potential. Now that you understand what correlation is, how to recognize it on a chart and the fundamentals that back it, it's now time to discuss how we use correlation to gain an edge over other traders. When most traders look at correlated pairs, they focus the bulk of their attention on the 98% of the time that the currency pairs do what they're supposed to do and remain correlated. Not me, I've always been more interested in the 2% of the time when correlated pairs fall out of correlation. And if by any chance you're worried 2% doesn't sound like a lot, I can let you in on a little secret. It's plenty often to produce continuous trading opportunities, if you know what to look for. Oh, by the way, I realize it may sound a bit counterintuitive to look for a correlation fallout, so please hear me out. You now know that correlations are backed by fundamentals. But not just any fundamentals, correlations in the Forex market are backed by universal market fundamentals. In other words, the currency pairs we're trading aren't correlated because some over-optimized, made-up indicator says that they're correlated. They're correlated because real-world market forces dictate that they must be correlated. So why does all this matter, and what does it have to do with gaining that edge that I promised? Well, it's simple. If we know that certain pairs are correlated, and that those correlations are backed by real-world market forces, then the 2% of the time when those pairs fall out of correlation, we know that something has gone wrong. We don't know what has gone wrong, necessarily, but we do know that at least one of the currency pairs isn't acting like it should. For example, remember the euro to US dollar and US dollar to Swiss franc? These pairs have a high negative correlation, meaning they should more or less move in opposite directions to one another. If all of a sudden these pairs fall out of correlation and begin to move parallel to one another, then we know that something is out of whack. And while it doesn't happen all that often, it's these times when things go out of whack that we're able to gain an edge. You see, when correlated pairs fall out of correlation, it's just a matter of time before they go back into correlation. Again, these are universal market fundamentals that are causing these correlations, and it's these market fundamentals that will force the pairs back into correlation. So here's what we know. We know that something has gone wrong, because the currency pairs aren't behaving like they should. We know that the pairs will eventually be forced back into correlation by real-world, fundamental market forces. We know that when the pairs move back into parity, i.e. correlation, that the movement will create significant profit opportunities. Did you catch that last one? We know that when the pairs move back into parity, i.e. correlation, that the movement will create significant profit opportunities. This is the single most important point of this entire section, so don't miss it. When correlated pairs fall out of correlation, a small moment of opportunity is created because we now know that there will be movement, i.e. volatility, when the pairs move back into parity. And where there's volatility, there's the potential for profit. Here's the deal, as a trader, it is impossible to profit without movement in the markets. We need volatility or we don't make money. But volatility alone isn't enough. To trade with maximum confidence and accuracy, we need predictable volatility, and that's exactly what correlation trading gives us. As correlation traders, we know that when correlated pairs fall out of correlation that they will return. And it's when things return to normal that we're able to take our profits. The giant flaw in correlation trading, the fact that you're still watching, suggests that you're probably getting excited about this concept of correlation trading. After all, correlation trading is easy to identify and trade. Correlation trading is backed by proven, timeless, universal market fundamentals. Correlation trading gives us the predictable volatility we need to trade with confidence and accuracy. It all sounds great, doesn't it? Well, unfortunately, correlation trading does have one giant flaw. While correlations will tell you that a move is about to occur, correlation alone doesn't tell you which pair is moving or the direction it will be moving in. In other words, you know you need to put on a trade, but you don't know which pair to trade or whether you need to buy or sell short. This massive limitation in correlation trading has stifled traders for years, which is why so few traders use correlations despite its obvious benefits. Let's dive into the follow the leader strategy so you can start profiting right now. The follow the leader correlation trade, like all correlation trades, follow the leader, waits until two correlated pairs go out of whack, and then quickly capitalizes on the opportunity to scalp some quick pips out of the market. Here's how it works. For this system, I like to trade the euro to US dollar along with the pound sterling to US dollar. These pairs are positively correlated, so as expected they are more or less moving parallel to one another. As you can see, But when we're trading with correlation, we're not only looking at direction, we're also looking at the range. Range, the difference between the high and the low prices during a specified period of time. We know, for example, that the pound sterling to US dollar normally has a much larger range than the euro to US dollar. Note, I don't have the time right now to go into why the range of the pound sterling to US dollar is larger, but if you look at the two charts side by side you'll be able to see with the naked eye what I'm talking about. In other words, while these correlated pairs will generally move in the same direction, the pound sterling to US dollar should have lower valleys and higher peaks than the euro to US dollar. So, when we see that the range of the pound sterling to US dollar is lagging behind the range of the euro to US dollar for 1 bar, we have a potential trade setup. Once the range lag is 20 pips or greater, we take the trade with the expectation that the pound sterling to US dollar will make up the gap and overtake the range of the euro to US dollar within a few bars. Remember, we know this is an extremely high probability trade, because fundamental law dictates that the pairs must remain in correlation, so therefore we know that they will eventually snap back. Like I said, it's a simple strategy, but because it's backed by market fundamentals it's one of the most accurate and profitable intraday strategies I've ever traded. Okay, so let's go back and take a look at the chart. Right now the range of the pound sterling to US dollar is lagging the euro to US dollar by 8 pips. That's enough of a lag to take notice, but it's not enough to take the trade yet. Remember, I like to see at least a 20 pip lag before I take the trade, so I'll watch it for another bar and see what happens. When the second bar closes, the range is now lagging by 15 pips. It's still not enough for me to take the trade yet, but the fact that the range lag still hasn't corrected itself, and is actually growing wider, has me very excited. I'll wait and watch it for one more bar and see if the range lag, or crack, widens enough for me to take the trade. The third bar has closed, and the range lag has now widened to 24 pips. That's greater than the 20 pip minimum I need, so I'm going to take this trade and go long on the pound sterling to US dollar. My expectation is that the pound sterling to US dollar will at a bare minimum make up the 24 pip range lag, or crack, and possibly even go beyond that since historically the range of the pound sterling to US dollar is supposed to be larger than the euro to US dollar, and again, when we're trading with correlation something goes wrong, as is the case with this range lag. That usually means there's a profit opportunity just around the corner. Now that we're in this trade, let's watch it and see what happens next. As you can see, the very next bar the pound sterling to US dollar made up the range lag and returned to normal, just as we expected it to. We then exit the trade at the end of the bar and pocket the 24 pips. So there you have it, the follow the leader strategy. So to recap, all you need to do is 1. Watch these two pairs simultaneously. 3. Track the movement of both pairs at the close of each bar. 4. Once you see one of the pairs begin to pull away, pay attention because you are now looking at a potential trade setup. 5. Calculate the range lag, or crack, and when it exceeds 20 pips, you're ready to pull the trigger, and you know what your target will be, as it will always be about equal to the range lag. I'm confident that this one strategy alone will make you a more confident, accurate and profitable trader, as these trades are ultra-high probability trades to take, and I love when they set up. Subscribe for more. Bye. See you in my next video.